Hello and welcome. You're watching KYC. I'm Hersh Sayta. With me is Anushi Vakharia. And you know, defense is the big theme that's playing out, right? We had one defense counter coming in yesterday, giving us extremely strong guidance, and therefore warrants better discussion. And today, therefore, we've picked IdeaForge as the company we want to discuss and talk about and speak with as well. So let me quickly first talk about what I want to know with regard to IdeaForge. I'm going to start off with point number one being execution, execution, execution. One thing is having an order book which is large, but the second piece is what's the visibility with regard to execution. And we'll talk about that. But more importantly, it's also the order book build-up which is necessary. What's the outlook like with regard to orders coming in? Have that improved in some fashion? And what's the outlook like going forward? Now, in terms of margins and profitability as well, where do gross margins stabilize at? Where do EBITDA margins stabilize at? And we're talking maybe not FY26, but we're talking maybe the next 3 years and the next 5 years. And that gives us better visibility on whether this one can actually be something that stands out within that defense space and within the private defense space, mind you. Can they stay ahead of competition with regard to the fast evolving technology that's playing out in unmanned aerial vehicles, which is the business that they do? What's the outlook with regard to overseas markets? They've spoken enough and more on all of their con calls about expansions into Oman, opportunities coming out of North America, Africa. They've spoken about the large India opportunity coming out. How quickly does that translate both India as well as overseas, but more importantly overseas? Improvement in working capital parameters. Now this is one of the other key drags in terms of the way the financials are playing out. You're seeing a sizable amount blocked in working capital. So these are all the points that I would want to know first off from IdeaForge, but we'll start off by understanding the business first. And it's critical to understand it because you want to understand whether there's a differentiator in the business or not. One, it's in the business of manufacturing unmanned aircraft systems. In simple terms, it's UAVs, which is unmanned aerial vehicles that they manufacture, and they're a leader in that market in India at the very least, and even abroad. From the commentary that they are suggesting, they're saying that they have in the pipeline and plus already ratified over 70 patents within this space, and therefore they are a leader in India but also looking to push with the global expansion that they have. Execution nearly completely depends on the order book is what they have suggested at the end of their Q4 con call, and therefore will be important to understand as to how both of those play out. But something from a business perspective that you must keep in mind: execution entirely depends on order book. Let's talk about the use case now. I'm going to start off with civil use. Surveillance, security, patrol and municipal. That's the broad breakup in the civil use segment. Then it's used within the mapping segment. In the mapping segment, land surveys, minings, estimations both of area as well as depth within certain civil and application use cases. And now then you have these four, which is largely to do with defense: anti-terror, border security, coastal security, crime patrol. Municipal cases also involve traffic management. So there are plenty of cases, right, of using UAVs, and therefore there's no lack of that. But these are the broad-based applications where IdeaForge has a presence. But you want to talk about some of the business verticals and how they are split.
Yeah, absolutely. So, you just emphasized on the last part about how they are catering to the defense side of the business. But from FY22 to FY25, if you are looking at the mix from the defense, that has come down significantly. From what was 80% of a mix has now moved to almost at the range of 60%, while for civil has seen almost a uptick of 20%. On the other hand, 20% was the mix earlier, which has now moved to 41%. Now, that's the kind of mix that we are looking at. But, let's talk about the broader products also which are there. First is the Zolt, which is a tactical drone that we are looking at. Most of the company products range in catering to the drone solutions that we are looking at. Along with that, we are looking at Yeti, which is a middle mile high altitude log drone as well. Now this drone is an important update that we are seeing, which is the Switch UAV services, which is declared as fit for Indian military usage. Now, just in the recent conversations, the defense industry had pointed out that there's a lack of drones in terms of where the military usage is concerned. So this one is an important one to keep an eye out for. Netra 5, another one, along with Flight, are some of the other drone services which are available from the company that we are seeing. Right, Harsh?
Yeah, absolutely. So Flight is actually their drone as a service offering, which is more of an annualized revenue, I would assume, but we'll quiz management on that as well. And more importantly, I want to also cover Yeti, because Yeti is something that they've been working on for the last couple of years. It's a middle mile high altitude logistics drone. So it's actually into logistics and delivery services. That's what Yeti is all about. So again, it's a very interesting concept which they are working on. So there's no lack of innovation here. That's what I'm trying to get to. There's plenty of innovation happening. Zolt is of course the tactical drone, and Switch UAV is the only one approved by the Indian Army, and therefore it gets a lot of validation in terms of its ability to be able to deliver high quality army grade equipment, which is what the big positive with regard to Switch UAV is all about. So that's the broad split. And in terms of how the order book has shaped up, FY25 end, the order book was at just about 14 crore. They've got new orders worth around 137 crore in this quarter, Anushi, if I'm not wrong.
Yeah.
And then there's an L1 order opportunity of around 400 odd crore. So that's how it really stacks up. Now, in terms of numbers, and we'll start off with the KYC metrics right off the bat. Let's talk about the metrics that we'll speak about. We'll start off with the income statement. Thereafter, we look at the balance sheet. We look at the cash flow. We look at shareholding, return ratios, street cred, we look at outlook, and we will look at valuation. So all of those parameters is what we'll try to cover today. Anushi, you want to start off with the income statement?
Yeah, absolutely. So with income statement, now you know what the basis is in terms of revenue. Now over here in the last 3-year period, it has almost been a flat performance as far as where the revenue visibility is concerned, which brings us back to the first point of Harsh's, just starting off with execution being a key part for the order book which is there. Even in terms of where the margins are, it's a negative kind of a picture that we are looking for margins in PAT as well. So, but the management is guiding for a 20% of plus of a blended margin going forward. So when does that flow in is something that we should be keeping a track of. Now, order book, if we are seeing last year, 13.6 crore was the figure that we clocked in, which is much lower than the FY24 and 23 figure of 124 to 192 crore respectively. Do note that it had been a lackluster year in terms of where the order inflows have been considered from the drone industry. So that is why we are looking at this kind of a figure. But emphasis more on the execution part remains, right?
Absolutely. And just to kind of take the viewers through the journey, yes, sales of 160 crore is flat when I'm looking at it over the 3-year period. But when you look at FY23 and FY24, we saw a spike on the sales numbers. In fact, top line was at 314 crore in FY24. So we've seen significant contraction in top line. This is largely because of order inflow not coming in a steady fashion. You look at the order book of just 14 crore at the end of FY25. That's, of course, the Q1 order book. But the FY25 order book stood at just 14 crore at the end. And therefore, there was not much of execution which was left to do. And therefore, what you're seeing is that the fixed costs are actually adding up. This is an EBITDA positive company otherwise. It's done 75, 48 and 57 crore of EBITDA in the last 3 years preceding FY25. FY25 was a loss, high fixed cost, high ESOP cost weighing down on the numbers for FY25, something that you must keep in mind, because otherwise on a normalized basis, the numbers don't look all that bad. But FY25 from an execution perspective was a weak one. From an order win perspective was a weak one. The orders that come in are chunky. The execution is therefore also chunky. And therefore, what you should look for in a company like this is over a 2-3 year period, what is it that they are delivering in terms of top line, in terms of margins, in terms of profitability. and it's not a one-year thing. Therefore, again, something to keep in mind and some perspective. Let's now look at the balance sheet, and when you're looking at the balance sheet overall, it's not looking like a bad one. You're seeing decent amount of equity to the overall market cap as well, around 2,500 crore of market cap, around 600 odd crore of equity. You're seeing borrowing which is far and few, so very, very low borrowing. But what's locked in really in the assets is 400 crore out of that 600 crore of balance sheet is locked in inventory, trade receivables, cash, and other working capital items. So what you're seeing is a large part of that amount, and cash is obviously good. 97 crore of cash is good. But outside of that, the around 250 crore of the balance sheet is locked in some of the working capital requirements, which is large. And that's a bit of a concern. Neutral from a balance sheet perspective, cash flows.
Now, in terms of where the cash flows are also, we are looking at a negative figure for cash flow from operations in FY25 in comparison with your FY24 picture that we are seeing. Again, a big result of this is also the kind of revenue recognition which has taken place. We've seen a downtick in terms of revenue almost at the likes of 40% or so in FY25, which is reflecting in cash flow from operations. There had been an increase in terms of receivables which were there, so which has resulted in this negative figure that we are looking at. Even net cash flow down minus 152 as compared to a positive 164 crore that we'd earlier seen. So on basis of that, we are also giving cash flow a neutral rating.
Okay, so neutral on cash flow, and that's also because of the build-up in receivables, which are not unwinding, the build-up in inventory, which is not unwinding. So some of those need to unwind, and maybe we will see some of that come through. But yes, that's still awaited. Let's now talk about return ratios, and this is a fascinating one, right? You had return ratios at 40% in FY22, and I want to again pull out and highlight that FY22 was a very solid year for the company. The operating margin or EBITDA margin of the company in FY22 was 47%. Chunky orders, right? Something to look out for. But that has tapered down. ROEs are now negative in this year, and we've highlighted reasons why. But otherwise, does the company have a capability of going back to higher ROEs if the EBITDA margins recover? And we spoke with management, we'll give you that perspective. So therefore, the neutral with regard to return ratios. Shareholding, Anushi.
So in terms of where the shareholding is concerned, not much of an activity that we're seeing in the last 3 quarters or so. Promoters' stake has remained at the 29% of a mark that we are looking at, while FIIs have trimmed their stake from 3.5% to 1.56%. So in that 1% of a range is what we are seeing. DII is playing around the range of 2 to 2.5% is what we are seeing, while public holds about 67% of stake in the company. So on basis of that, we've given a neutral rating to this one.
Okay, let's quickly look at street cred now, and this doesn't look pretty at all. Let me be very frank. 11% down in the last 6 months, but even when you look at it since the day of the listing, stock is down 56%, down 29% on the last 12-month performance, and therefore clear thumbs down with regard to this one. It's looking very difficult from a street cred perspective. You want to talk about valuations, Anushi?
Right. So in terms of where the valuations are, we've just discussed that, in FY25, the company had clocked in a loss in terms of where the EBITDA was concerned and net profit was concerned. So to get a better perspective for comparison, we have taken the market cap to sales approach for this one. If you look at IdeaForge over here, it has a multiple of 15.4 times. This is based on its FY25 sales number that we are looking at in comparison with Paris Defense and Zentech, who operate in similar spaces, which have about 18.8 to 18 times of a multiple is what we are seeing. So we are giving it a neutral on basis of that number.
If execution were to improve and if margins were to improve, you could well see this number change. And that's something you want to keep in mind, and which is why we're giving this a neutral, because the upside to this could well be good because the base was higher and it's come off very sharply. Due to whatever macro factors, could that change is the question. Let's look at outlook now. Government expected to drive procurement as well as drive the larger market size. Expected EBITDA margins of 20% plus is what they've guided for. Blended gross margin of 45 to 50% is what they've guided for. R&D capex of around 77 crore annualized for FY26 is what they've guided for. First demo of the US defense drone is done. Now, They need to try and work more, get their early adopter out of the way, and start getting orders. That's the US expectation. Do not expect to take on debt. Expect a soft Q1 FY26. This is basis Q4 commentary, and execution readiness. They are waiting for order inflow, is what they say. But we spoke earlier with the CEO of IdeaForge, Ankit, and here's what he had to say. Listen into the whole conversation. I want to first talk about the 150 crore order pipeline that you have. And I'm not asking with regard to Q1 FY26, but for the full year. What's the outlook like? How quickly can you execute this order book? Because your capacity utilization, at least basis Q4 commentary, suggested you can execute fairly quickly. So trying to understand that.
Yes, absolutely. I think the attempt and the target is to execute it as quickly as possible insofar as this is concerned. And we are going to essentially, do it also not just because we have capacity, but I think it's also a very immediate need for our country. So our focus will be to get the capability in the hands of our user as early as possible.
Hi, Mr. Mehta. This is Anushi joining in as well. So last year, if we take the order book in context, it was around 14 crore that we saw. This quarter, you recorded more than 100 crore plus of an order win. Just want to get a sense from FY25 to 26, what would be different in terms of where the order inflow picture is considered, and how do you expect to close the year with the FY26 order book? If you can give us more details on that front.
Yeah, so I think, Anushi, if you look at what has been announced recently regarding the next emergency procurement post the Operation Sindoor, Indian Army has been given a 9,000 crore budget to quickly induct more technology, particularly replenish what was consumed, as well as induct more technology in their ranks and forces so that we can be more prepared for any eventuality. And therefore, we do expect that that conversion will also happen sometime in this year. And once those conversions happen, we will have to also rush to deliver the capability to our end user.
Mr. Mehta, if you can just quantify the numbers for us, if we can take from FY25 to 26, what would be the growth picture be in terms of where the inflows are considered? And also a sense from these 14 crore of an order book that we saw in FY25, where do you see this number heading towards in FY26, considering that you have a 400 crore of a visibility as well in terms of order pipeline?
Anushi, the visibility that I can provide right now is that there is a good amount of capital earmarked for purchase of drones and counter-drone systems by the Government of India. Having said that, how much of it will convert to IdeaForge's bucket is something that we will sort of only talk about when we have those orders in hand, because in this space, it is very important to be a bit more conservative in terms of what we are projecting because of the vagaries of the business and the processes.
Mr. Mehta, then give us a 2 to 3 year outlook, if not FY26. Because what your shareholders and investors will want is how quickly can you execute. The potential seems large at 400 crore of L1 potential, which you've highlighted. But how much of that converts is really the question. Again, on the Indian defense as well, the budget seems large, but how much of that converts to drones and specifically to you? Just give us that broad picture. It gives us better perspective.
Sure. So Hersh, what happens is that typically, the procurement for drones is earmarked within the overall budget that the government has. What we understand over the next 2-3 years is that there is an intent to look to buy this technology in large numbers and to buy it consistently. That's the view and the vision that we have from our forces. And therefore, we can expect that a lot of conversions will happen within the drone industry. Within the industry, we are not serving each and every use case. So we are serving the use case for ISR and we are serving the use case for multi-role assets. And within that, we will have to carve out, what is the picture that is converting for us. Our win rate within what is attemptable by us is usually very high, and we are able to grab a good market within that because of our capability that we've built, as well as now a new vector has come in, which is resilience to electronic warfare. That's an area that we've been talking about in all our calls. We've been talking about the technology that we're developing there, where we were working towards frequency hopping, multi-frequency communication. We've been talking about working on GNSS denied navigation, and all of these capabilities become very real and important and will become an integral part of what the government is going to buy. So we do find ourselves in a leading position insofar as that capability is concerned for the kind of drones that we build. So between these, 3, 4 vectors, we feel very confident that we have a good possibility of converting a substantial amount of the pipeline for our domain in our favor. But what are the exact numbers? How many orders and how many units are the government going to procure is something that we'll only get to know once the RFPs are out and we start bidding for them.
Understood, Mr. Mehta. So this is in terms of where the order conversion and execution is considered. But if you take the order book visibility, it is very important to focus on that, considering that if you look at the last 3 years of revenue growth, that has been more on the muted side. It's almost flat. So just want to get a sense on the revenue visibility also for the next 2 to 3 years. What is the kind of growth? Is it a double teen kind of a growth, or more than that growth can we expect? And the margin range also, because if we look at the margins, there has been variation in terms of whether quarters or the financial year performance has been. So give us a sense on these two metrics as well.
See, what we look at in terms of blended margins, Anushi, is that we are typically looking at between 40 to 45% of gross margin expectation on a blended basis from our pipeline. But please, account for the fact that when an individual opportunity closes, it may have a higher or lower gross margin depending on the nature of the competition in that bid and what that product is all about. So, we should expect that individual opportunities that convert will have the variability, but on a blended basis, our margin expectation is remains the same. And yes, we can expect growth in this year. We do expect conversions from our pipeline, both the L1 pipeline and our opportunity pipeline, which is significantly larger than the L1 pipeline as well, to happen this year and subsequently in the forthcoming years as well, from whatever we understand of the intent of procurement by government, particularly in defense. And we are seeing that a lot of work is also going to happen in the homeland security and in the civil domain as well. And therefore, on a overall basis, we believe that India is going to see a rise and a better, opportunity for the industry as well as for us in the next couple of years and beyond. And we expect that in this time frame, we will also start responding and start receiving orders from international markets. So overall, we expect growth from this overall diversified approach of what we have been planning and what we've been building towards over the last couple of years.
But again, coming back to the numbers, what can we expect in terms of top line? Is there a broad level thought process, given that now you don't just have India to look at, or maybe an election year which will drag your numbers? It will be global. You have traction coming in from Europe, UK. You have now a decent presence in North America as well. You've started ramping up there as well. So you've got diversified presence. Is there better visibility on top line, sir?
See, there is better internal visibility, but for me to talk about it,
Sure.
we're not there yet. Let me put it this way.
Okay, sure. And are the margins in exports better than domestic?
See, we are currently pitching, the more capable products in the international markets, because we believe that differentiation is very important when we go out there and we present ourselves as a credible player. Because, if we are looking at the run-of-the-mill capability or performance, then, there is a lot of competition everywhere in the world. And therefore, because we are pitching our premium products there, we should expect good margins and healthy margins there. But we will only sort of, know when we convert some of these opportunities in practice.
Sorry,
But
just want to...
there is a tight governance happening on that. We should expect closures as well.
Right. I want to close the loop with regard to margins. So you're guiding blended 45 to 50% blended. Where does
But
that
it doesn't show up. So Hersh, sorry to interject. It doesn't show up year on year, because in a particular year, if I have a specific, like it happened last year.
Yes.
So the idea is that typically the pipeline looks of that nature, but what converts in the pipeline will show up slightly differently. We've had years where we have much better margins, and we've had years, particularly one year last year, where we had slightly more muted margins. So it depends on what we are executing in that year more than anything else.
No, for sure, Mr. Mehta. So we've explained that to our viewers as well. So that is well recognized. But But say you're at 45-50% blended gross margin, at least that's the visibility today. Where does that leave you on the EBITDA margin front? Because your fixed costs have also gone up in relative terms. So wanting to understand visibility with regard to fixed costs, ESOP, and therefore the net EBITDA margin, where should that lie?
So between the last 2 years, if you actually see our expenses on the people front were relatively flat. There have been minor increase in expenses on the other expenses, which is expected as you expand your facilities and a little bit more effort goes into maintaining what we are working towards. So overall, expenses actually remained relatively flat, and it was the impact of the lower base that hurt us more last year than real change in the cost in a very big way. And therefore, as the revenue base grows again, we will start seeing improvement of EBITDA margins, and we may get back to healthier EBITDA margins of at least 20+% and healthy PAT margins as well. So I think it's a matter of revenue base at this point in time than the cost base, because we aren't increasing the cost base as aggressively at this point in time.
Okay, so at 20% is the kind of margin levels that we should be watching out for IdeaForge. Understood. Now, just want to get an overall industry outlook, Mr. Mehta. You know, drones, after the recent developments, it's an upcoming area in focus. Just want to get your sense in what usually is the kind of market share that you hold in this particular space, and how many players are there, domestic, international? If you can give us how, in terms of bidding also, how many competitors are there, how competitive is the space?
See, I'll start with the competitive sort of landscape in the space. In every opportunity, you have a very large number of people who bid. But in the end, when it comes to actually demonstrating capability, you will find that only 5 to 6 people actually turn up to demonstrate something to the ground. And within that, there are various sophistications, capabilities that the consumer demands. And I don't think more than 2 or 3 players typically meet that capability. So while there is a lot of noise, a lot of competitive, you can say, pressure from the point of view of how many people want to be in the domain, but people who can actually meet the requirements of the end customer, typically you will not find more than 2, 3 people qualifying, depending on what the opportunity is and what are the areas. In fact, in some cutting edge capabilities, there is no competition to what we build. So it entirely depends on what is the specific opportunity. Usually, there are not too many players who qualify those opportunities when it comes to real testing on ground.
We also spoke about working capital. That seems to likely get better going forward. But completely out of time on this edition of KYC. From Anushi, myself, everyone who puts the show together, thanks so much for watching.